Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Uber.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Absolutely. And just a quick reminder before we really jump into the numbers today. If you want to see the exact trade signals and the real-time data we're looking at, make sure to check out the VIP Algos link. It's right down there in the description below.
Yeah, definitely go check that out. It's super helpful. But okay, let's just get right into the actual analysis for today because this one is, well, it's honestly fascinating.
Oh, it really is.
Matt, you've got a student, right? And for years, they're just constantly struggling, scraping by, making excuses, always needing a bailout from their parents.
Right, the classic underachiever.
Exactly. But then, one semester, they finally put it all together, they grind it out, and they hit a perfect 4.0 GPA.
A total turnaround.
Right. But then, as a reward for this massive achievement, their parents decide to just, cut their allowance.
Which makes absolutely no sense.
None at all. But if you look at the market right now, that is exactly what is happening to Uber. I mean, looking at the data, the disconnect between what they are actually earning and how the market is treating the stock is completely wild.
Yeah, it really is one of the most bizarre valuation paradoxes out there right now.
Okay.
Because, for years, the whole financial narrative was that Uber was just this giant cash-burning experiment, right?
Oh, totally. Heavily subsidized ride.
Exactly. A company that only existed because venture capitalists were footing the bill for every single ride.
Uh-huh.
But the analysis we're digging into today outlines this massive fundamental shift. They've quietly matured into a highly profitable global super app.
Yeah, it's not the same company anymore.
No, not at all. The core business is generating historic amounts of free cash flow, but investors are just treating it with this extreme skepticism. So our goal today is to really decode that mismatch, right? Is the market just asleep at the wheel, missing a massive opportunity? Or is there some hidden flaw we're not seeing?
Well, let's lay out the sheer scale of this disconnect first,
Yeah.
because the fundamentals are pretty staggering. So on the market side, Uber's stock is currently hovering right around $72.46.
Right.
Which means it's sitting about 29% below its 52-week high. And it's down over 11% just year to date.
Ouch. Yeah, that looks terrible on the surface.
It does, but then you actually look under the hood at the money flowing through the app, and it's a completely different universe.
A total 180.
Yeah.
Yeah.
Revenue is growing at 18.31% year over year. Gross margins are sitting at a really healthy 35.5%. And here's the absolute kicker. Their net margin has hit almost 16%, 15.91 to be exact.
Which is just incredible for them.
Right. For a company that was famous for losing billions, approaching a 16% net margin is just a massive structural inflection point. They're generating a trailing 12-month earnings per share of $4.02.
And that margin flip is really the crux of the whole story here. How they got there is all about this concept of operating leverage.
Okay. Unpack that a bit for everyone listening.
Sure. So in the early days, they had to spend absurd amounts of money to build the technology, map all the cities, acquire the drivers and the riders.
Just burning cash on promos.
Right, massive fixed costs. But software platforms, they scale beautifully. Once that algorithm is built and the network density is there, the cost to facilitate, one additional ride or deliver one more burrito is virtually zero.
It just drops right to the bottom line.
Exactly. Every new dollar of revenue just falls straight down to profit. That 16% net margin basically proves the fixed costs are paid off and the machine is finally just printing cash.
But despite that cash printer going brr, the market is severely discounting it. I mean, because of that $4 EPS, Uber is trading at a price-to-earnings ratio of about 17.3.
Which is just so low.
It's crazy. A PE of 17 is what you normally see for a legacy regional bank, or some stagnant brick-and-mortar retail chain.
Definitely not a high-growth tech platform.
No. It's an incredibly compressed multiple for a dominant tech company growing its top line at 18%. Which brings us back to that 4.0 GPA analogy, right? If they are this profitable, why price them like a dying legacy business?
Well, I think the market is just suffering from a really deep psychological hang-up. Institutional memory is powerful. For over a decade, traditional finance folks just assumed Uber's unit economics were fundamentally broken.
Right, the old they'll never make money argument.
Exactly. They thought the second Uber stopped subsidizing rides, growth would just vanish. And even though the math completely disproves that now, the bias is still there. It's honestly like a form of financial PTSD.
That's a great way to put it.
Yeah, portfolio managers look at Uber and they aren't seeing the current balance sheet.
Well,
They're
yeah.
projecting their historical fears. They see macro headwinds, inflation, interest rates, and they just automatically assume the profitability is a house of cards that's going to collapse.
So they're literally just seeing ghosts. They're
Right.
pricing in the risk of like the 2018 version of Uber and totally ignoring the 2026 reality.
Precisely.
And the reality is this is a company with a market cap of nearly $147.7 billion, and they are using that cash flow in ways the old Uber never could.
Oh, absolutely.
Which brings us to the real massive catalyst here, the big move. On July 17th, Uber announced this massive $14.8 billion acquisition of Delivery Hero, which is this huge player based in Germany.
And that deal just completely reshapes the global chessboard. They're taking all that newly minted cash and just systematically buying out the competition.
Right, because Delivery Hero was dominating food delivery in huge chunks of Europe and Asia.
Yeah. By absorbing them, Uber isn't just, slowly creeping into a few new cities. They are instantly expanding this combined mobility and delivery platform into 99 countries.
99 countries. Just wrap your head around running a logistics network on that scale.
It's insane.
And the UBS analysts are heavily backing this move. They're arguing it gives Uber this incredible profit upside because it instantly plugs all the geographical holes Uber Eats had overseas.
Right, rather than fighting trench warfare for 5 years to win over customers.
Yeah, offering crazy discounts and bleeding cash.
Exactly. They just buy the competitor and take the market share overnight. Customer acquisition and delivery is brutally expensive. By buying Delivery Hero, Uber gets the established restaurant relationships, the courier networks, and millions of active users in one single swipe.
But okay, let's play devil's advocate for a second.
Yeah.
A $14.8 billion price tag is huge, and it comes with serious execution risk.
Oh, for sure.
Like, expanding to 99 countries looks great on a spreadsheet, but you're talking about integrating a massive German corporate culture with Uber's, historic Silicon Valley tech bro roots.
It's a recipe for friction, yeah.
Plus, European Union antitrust regulators are notoriously aggressive. They do not like American tech giants swallowing up their local markets. So, is bigger always better, or is this going to turn into a massive integration nightmare?
Well, the cultural and regulatory friction is absolutely a real threat. I mean, EU regulators will definitely drag this through the mud, looking for monopoly issues. But the analysis makes a good point. Uber has kind of earned the benefit of the doubt on M&A at this point.
Because of Postmates?
Postmates and Corner Shop, too. They aren't rookies at this anymore. They have the internal muscle memory to absorb big teams and migrate millions of users onto one unified tech stack without breaking the app.
Right, and honestly, they're willing to stomach the regulatory headaches because the payoff is just too massive.
Oh, the multi-sided network effect.
Exactly. Let's break that down because when you have riders, drivers, restaurants, and couriers all connected across 99 countries, it creates this data flywheel that is basically impossible for a regional guy to replicate.
Right. So think about how that flywheel works in practice. Let's say a driver drops off a rider in Berlin. Normally, they might have to drive around empty for 10 or 15 minutes looking for the next fare.
Just wasting gas.
Exactly. But with this unified network, the algorithm can instantly route that same driver to pick up a Delivery Hero order just a block away.
Ah, so it eliminates the deadhead miles.
Yes. It maximizes the driver's hourly earnings, and it actually lowers the cost of the delivery for the consumer. Some local European delivery app simply doesn't have the density of both human mobility and food logistics to offer that kind of routing efficiency.
And that data density fuels something else entirely, which is the advertising side.
Right, a huge margin booster.
Yeah. If you have millions of people opening the app multiple times a day in 99 countries, whether they're commuting or ordering dinner, that is prime real estate. You can build an ad platform that local competitors can't even dream of.
Absolutely.
But owning all that data doesn't just help them deliver a pizza today. It's actually laying the groundwork for their next massive play. Because if Uber is dominating the global dispatch algorithm, the next question is who or what is going to actually be driving those cars in the 2030s?
And that leads us straight into their autonomous vehicle strategy, which might be the most critical long-term indicator we're looking at today. They recently forged this huge strategic partnership with Lucid and Nuro to build out a robo-taxi fleet.
And the key word there is partnership.
Yes, exactly.
This is a massive pivot from what they were trying to do years ago. I love the airline analogy for this. Instead of trying to build the actual airplanes, Uber just wants to be the air traffic controller.
Right. Let someone else take the manufacturing risk.
Yeah, they're letting Lucid spend billions on R&D, figuring out the hardware, the LiDAR, the sensors. And Uber's just going to sit back and route those cars using their existing 99-country algorithm.
That platform as a service model is the ultimate key to their future margins. For years, the biggest threat hanging over Uber was this idea that they had to build their own self-driving cars to survive.
Which is a terrible business model.
It really is. Manufacturing vehicles destroys balance sheets. It's insanely capital intensive, and Uber is, at its core, a software company.
Right. Hardware depreciates the second you finish building it, but software scales infinitely. By partnering with Lucid and Neuro, they get this beautiful asset-light strategy.
Because Lucid takes the financial risk of building the actual cars. But here's the catch. Lucid doesn't have a network of millions of riders waiting on a street corner.
They need Uber's demand.
Exactly. So Uber basically gets to tax the entire robotaxi industry without having to tighten a single bolt. They become the inevitable dispatch layer for all autonomous logistics.
It's just free optionality. If Lucid builds a great car, Uber routes it. If someone else builds a better robotaxi in 5 years, Uber can route them too.
Yeah.
They hold all the leverage because they own the consumer demand.
Yeah, it's brilliant.
So, okay, if the business mechanics are this strong, we're talking record profits, a really cheap PE ratio, this massive data flywheel from Delivery Hero, and a flawless autonomous strategy, who's actually noticing? Because the stock is down 29% from its highs, so everyday retail investors clearly aren't buying it.
No, retail's mostly sitting on the sidelines. But the quantitative sentiment data shows us exactly who is buying, and the smart money is moving in aggressively.
Okay, tell me about the insider flow.
Yeah, the data tracks insider flow, and it shows net buying of over 54,000 shares over the trailing 90 days.
And just to clarify for everyone listening, when we say insiders here, we are talking about the executive, the board members, the VPs.
The people who actually see the daily internal dashboards.
Right. They see the real-time Delivery Hero integration data. They know the actual subscriber numbers. If they're aggressively buying their own stock with their own money, that's a massive signal.
It really is. The metric we look at for this is the Insider Market Sentiment Percentile Rank, or MSPR. Right now, Uber's Insider MSPR is at 100.
Wow. 100.
A perfect 100, meaning insider sentiment is in the absolute top percentile of the entire stock market. It literally does not get more bullish than that. When the people running the machine are buying while the stock is near a 52-week low, they're screaming that the market has fundamentally mispriced the asset.
And the broader financial news seems to be catching on too. Like 4 out of 5 recent major headlines about them are explicitly positive.
Yeah.
But there is also this really intriguing, highly speculative rumor flowing around regarding the billionaire investor Bill Ackman and his hedge fund, Pershing Square.
Yeah, the institutional chatter is definitely heating up around that. There was a recent news item tracking Ackman's portfolio moves, and it referenced a holding that just dropped a $14.8 billion takeover bid.
Okay, and while it didn't name Uber explicitly...
Right, it didn't name them, but that exact dollar amount lines up perfectly with the Delivery Hero announcement.
It's too specific to be a coincidence.
Exactly. It strongly suggests Pershing Square might be initiating a massive position to exploit the exact same valuation gap the insiders are seeing.
Which creates a really fascinating dynamic if you're watching this stock just sort of drift downward lately. Trading volume right now is unusually low. It's sitting at about 0.79 times its 3-month average. So you have insiders buying at maximum levels. You have massive hedge funds potentially circling. Yet everyday trading volume is totally suppressed. It's like the broader retail market is just asleep at the wheel, completely missing how transformative this Delivery Hero deal is.
Yeah, analysts call that pre-deal drift. The broader market sees a giant acquisition. They assume there's going to be regulatory drama or integration costs, and they just lazily let the stock float down based on macro fears. But the underlying fundamentals are pointing violently in the opposite direction.
Okay, but as compelling as this bull case is, we have to remain objective. We want to give you guys the full picture. So if the PE is cheap, insiders are buying, and the strategy is sound, why did the stock actually draw down so much? What is the bear case that could shatter this thesis?
Well, the bear case lives almost entirely in the macroeconomic environment. Uber doesn't exist in a vacuum. right? They are super susceptible to broader market tides, and there's a huge headwind right now called token shock that's sweeping the tech sector.
Right, token shock. Let's explain how that actually impacts a logistics company, because on the surface, it doesn't seem connected at all.
Yeah, it's a bit of a domino effect. So token shock refers to the skyrocketing costs of running these massive generative AI models.
Right, server costs going through the roof.
Exactly. The fear is that AI is getting so incredibly expensive that enterprise adoption will just stall out. And you might think, what does that have to do with Uber?
Right, they deliver food, they aren't OpenAI.
Exactly. But it's like being the best house in a bad neighborhood. If institutional investors panic over out-of-control AI spending, they will aggressively sell off broad tech ETFs. And because Uber's a massive component in those funds, their stock just gets dragged down mechanically. It's guilt by association with the tech sector.
That makes total sense. That's just how the modern ETF market operates. They get thrown out with the bathwater during a tech panic.
But beyond just systemic market risks, there are real direct threats to their core business model. The biggest one is a consumer spending slowdown.
Oh, absolutely.
I mean, no matter how great their algorithm is, taking a premium ride to the airport or getting a restaurant meal delivered to your couch, that is purely discretionary spending.
It's the first thing to go.
Right. If inflation pinches the middle class or unemployment ticks up even a little, mobility and delivery bookings are instantly cut from the household budget.
And when you expand to 99 countries, you are suddenly exposed to 99 countries worth of localized problems.
Exactly.
Like, the data is very explicit about geopolitical volatility being a huge risk factor here.
Yeah, global logistics requires stability. The analysis points to ongoing tensions in places like Gaza, Kharkiv, and the shipping lanes of the Hormuz port. And looking at this strictly through a data lens, any escalation there triggers market sell-offs.
Because if a conflict shuts down a port, oil prices spike.
And when oil spikes, the cost of operating a vehicle goes through the roof. That either destroys the profit margins for Uber's drivers, or it forces Uber to raise consumer prices so high that demand just evaporates.
And Uber stock is mathematically wired to react really aggressively to those global shocks, right? The data mentions their beta is currently 1.156.
Yes, so beta is just a metric that measures volatility relative to the S&P 500. Since Uber's beta is over 1, the stock acts like an amplifier. If macro fears cause the broader market to drop 1%, Uber's likely to drop significantly more than that.
It's jumpy, but to be fair, that beta works in both directions. If the macro environment improves, like, say, if the Fed executes that rate cut in September 2026 that everyone's anticipating, that volatility becomes a massive tailwind.
Oh, totally. Lower interest rates are rocket fuel for growth and tech stocks because it makes their future cash flows much more valuable.
So it cuts both ways. The geopolitical risks are real, the macro risks are real. But the core argument here is that at a multiple of just 17 times earnings, a tremendous amount of that pessimism is already priced into that $72 valuation.
Exactly. The real moment of truth, the catalyst that will prove who was right, the market or the insiders, is going to be their upcoming Q2 earnings call in August 2026.
Right, August is the proving ground.
The narrative has to finally meet the hard data. Institutional investors are going to demand highly specific updates on the Delivery Hero integration. They want to see the synergies, like how much overlapping cost have they cut, how fast are users migrating.
And they'll be laser focused on the Uber One subscriber numbers too.
Oh, absolutely. That subscription model is the holy grail for them. It turns unpredictable, discretionary spending into recurring, predictable revenue. If they can prove that new 99-country footprint is accelerating Uber One subscriptions, it validates the entire bullish thesis.
Okay, let's bring all these threads together for you guys listening. We started by looking at this wild valuation paradox, a company executing flawlessly, but being punished by the market.
Right.
And what we've uncovered is a classic story of a market looking backward at historical ghosts while the company is just aggressively building the future. They aren't the cash-burning experiment of the 2010s anymore. Thanks to software operating leverage, they are a cash-generating engine growing at 18%, trading at a discount because of ETF sell-offs and macro fears.
While the retail market frets over AI token shock, the insiders are just quietly loading up. They're using their cash to consolidate global power with Delivery Hero, and they're cementing their role as the indispensable air traffic controller for autonomous vehicles, smartly letting companies like Lucid burn their own capital on the hardware.
It's really a masterclass in platform economics. They don't want to own the cars or cook the food. They just want to own the definitive routing layer for the physical world.
Which leaves us with this really profound almost philosophical concept to think about. If you track this trajectory out over the next few years, if they successfully absorb Delivery Hero, optimize logistics globally, and become the default dispatch layer for robotaxis, their identity fundamentally changes.
They transcend being a simple service provider.
Exactly. They won't just be a convenient app anymore. They effectively become the underlying operating system for physical movement in those 99 countries.
Wow. That operating system for the city itself.
Think about the power of that data flywheel. When one single, globally optimized algorithm dictates how you commute, how your groceries arrive, and how autonomous fleets navigate the grid, what happens to regional competitors still trying to run a basic taxi dispatch?
They don't just get outcompeted, they become mathematically obsolete.
Precisely.
It's a completely wild perspective shift, definitely something to mull over the next time you open the app. Now, keeping all of this in mind and remembering that this isn't financial advice, just analyzing the data in front of us, the overall rating here is a bullish 8 out of 10. The long-term view looks incredibly strong given the fundamentals and insider sentiment we discussed today.
Absolutely.
Thanks for joining us as we unpacked the underlying mechanics of Uber's global strategy today. Remember, if you want to see the real-time trade signals and the analytics driving these insights, check out the VIP Algos link down in the description.
Yep, it's a game changer.
And if you found today's talk useful, please consider subscribe, like, and comment underneath. We'll catch you on the next one.